Imagine this. You are 55 years old, you've spent the last 30 years doing everything you are supposed to do. You saved every month, you invested consistently, you reinvested your dividends, you ignored the headlines, you stayed the course. Then, upon one day, you log into your investment account and see £340,000. Not bad.
Wow.
Most people would be thrilled with that. But then, you run the numbers and you discover that if you made just 3 different decisions on day 1, which broker you used, which account you opened, and which fees you accepted, that £340,000 could have been closer to £490,000. That's a £150,000 difference. And here's the crazy part. You didn't lose it in a market crash. You didn't pick bad stocks. You didn't panic sell. You didn't make a single catastrophic mistake. You just chose the wrong broker. £150,000 gone. Without a single bad investment. Now, if that sounds dramatic, stick with me, because today I'm going to show you exactly how that happens and, more importantly, how to avoid it. We've all heard the quote, compound interest is supposed to be the 8th wonder of the world. Whether Einstein actually said it or not doesn't really matter, because the principle is true. But here's the part nobody talks about. Compounding works both ways. Your returns compound, but your fees compound too. And unlike returns, fees are guaranteed. Let me make this concrete, because I think most people hear fees matter and nod along without ever actually feeling it. 2 investors same portfolio, same 7% annual return. One pays not 25% in total annual costs, the other pays 1.5%. After 30 years on a £200,000 portfolio, the low-cost investor ends up roughly with £1.47 million. The high-cost investor, about £950,000. That's over £500,000, not lost in a crash, not in a bad trade, just quietly gone. And here's what most people get wrong. When we talk about broker costs, we are not really thinking about trading commissions. Those are actually the least important costs for most long-term investors. The ones that hurt to bore are the boring ones: platform fees, custody fees, FX conversion fees, fund charges, the spread on every trade, interest you are not being paid on your cash sitting there doing nothing. These don't send you a bill, they just disappear every year for decades. So no, choosing a broker is not an admin task you do once and forget about. It's one of the most important financial decisions you will make. And the goal isn't finding the cheapest broker, the goal is sleeping well at night. As Buffett put it, rule number 1, never lose money. Rule number 2, never forget rule number 1. Right, I'm going to walk you through 10 criteria, not in the boring feature comparison way most broker videos do it. We are going to talk about why each one matters, what it costs when you get it wrong, and how the main platforms actually stack up. When I compare brokers, these are the 10 things I look at. 1. Safety, because a cheap broker that disappears is the most expensive broker you ever use. Tax efficiency, ISAs, LISAs, SIPs, the legal wealth multipliers hiding in plain sight. Long-term costs, not commissions, but the fees that quietly matter most. Investment choice, what can you actually buy and where it is domiciled. Passive investing support, because most of us should be boring on purpose. Currency support, the invisible wealth tax nobody talks about. Recurring investing, how automation quietly makes you rich. Fractional investing, why the price of one Amazon share shouldn't be varied. Interest on cash, idle money either earns or quietly shrinks. Broker quality beyond fees, because not everything that matters shows up in a comparison table. Let's go! 1. Safety first. Before we talk about fees or features for any other exciting stuff, I want you to think about the worst case. Because here's something most investing content skips over. Your broker will fail. It has happened, it will happen again. In 2011, MF Global, at the time one of the largest brokers, collapsed overnight. Client funds were missing, people waited years to get their money back, some never fully did. Now, the UK has one of the strongest investor protection frameworks in the world. But it only protects you if your broker is actually covered by it.
What?
The Financial Services Compensation Scheme, the FSCS, covers up to £85,000 per person per broker if a UK regulated firm fails and can't return your assets. Just to be clear, that's protection against broker failure, not market losses. If your investments drop in value, that's the market doing what markets do.
What?
But if your broker goes under and your shares go missing, the FSCS has your back up to that limit. So when you are evaluating any broker, ask 4 things. Is it regulated by the FCA, not just passported, but generally supervised? Are your assets held in a segregated account, legally separated from the broker's own money? Is your uninvested cash protected? Cash is often treated differently from investments. Worth checking. And how financially stable is the broker? Profitable? How long have they been operating? Here's how the main platforms compare. Interactive brokers, my gold standard for safety. FCA regulated, enormous balance sheet, been around since 1978. If IBKR fails, honestly, we probably have bigger problems. Vanguard UK, one of the most trusted names in global investing. Jack Bogle founded it on the idea of putting investors first. Their mutual ownership structure means the clients are the owners. About as safe as it gets. The Giro, solid regulation, but one nuance worth knowing. They historically practice securities lending. Lending your shares to short sellers, you are not the direct beneficiary of that. They've improved their protection over time, but it's worth reading the small print before you dive in. eToro, FCA regulated for UK users, SISEC for European users. Acceptable but not as robust as IBKR or Vanguard. investengine, Trading 212, Moneybox, all FCA regulated. All FSCS protected. Newer platforms but legit and properly overseen. The bottom line, a cheap broker that disappears is the most expensive broker you will ever use. Most people ask, can I buy stocks for free? Wrong question. That's like choosing a house because the front door is chic. You should care about the entire structure. Safety first, always. 2. Tax efficiency. I'm going to tell you something that might save you more money than picking the perfect stock. And it's completely legal. No fancy strategy, no secret investment, no expensive course. Just ticking the right box when you open your account. That box is called ISA, an individual savings account. And honestly, if you are investing in the UK and you are not using one, you are making life much harder than it needs to be. Here's how it works. Every tax year, you can put up to £20,000 into an ISA. Inside that ISA, everything grows completely free of income tax and capital gains tax. Forever. No CGT to worry about. No tax-free time, no bill when you sell, nothing. Let me show you what that means over a lifetime. Same assumption, 7% annual growth, £500 monthly contributions, 30 years. In a taxable account paying CGT at 20% on gains, your pot ends at roughly £560,000. In an ISA, roughly £680,000. That extra £120,000 came from doing nothing except ticking the box. And that's just the basic ISA. There are 3 wrappers every UK investor should know about. The Stocks and Shares ISA, your primary long-term wealth builder, 20,000 annual allowance, every penny of growth tax-free.
Wow.
The Lifetime ISA, and the LISA, possibly the most underused gift in British personal finance. If you are between 18 and 39, you can put in up to £4,000 per year. The government adds a 25% bonus on top. That's a guaranteed instant 25% return before a single investment grows a penny. Think about that for a second. You put in £4,000, the government hands you £1,000, your financial advisor is charging you to find products that might return 7% in a good year. The government is offering you 25% guaranteed on day one. There are restrictions. It's mainly for a first home or retirement, but within those constraints, it's amazing. The SIP, the Self-Invested Personal Pension for Retirement. Contributions get tax relief at your marginal rate. A basic rate taxpayer puts in £800 and £1,000 lands in their pension. A higher rate taxpayer, just £600 for a £1,000 contribution. It grows tax-free. You pay income tax when you draw it in retirement, but typically at a lower rate than when you were earning. So, which brokers actually support this? Vanguard, investengine, Trading 212, Lightyear, and I know that some countries in Europe also offer some tax advantages for investors like the Netherlands, Ireland, Germany, Luxembourg, and more, but I'm not well informed about these markets. I want to be straight with you here. If you are a UK investor using the Giro or eToro as your primary long-term account and you are not maxing an ISA somewhere else, you are paid tax you don't need to pay. On growth you've already earned for decades. These are good platforms for certain things, but not having access to tax wrappers is a disadvantage that compounds just as ruthless as fees do. Use your wrappers, all of them, every year, because keeping more of your gains is just as important as making them. 3. Long-term costs. Quick question. What costs you more over 20 years? A 10 quid trading commission every time you buy shares? Or a 0.25 annual platform fee on £150,000 portfolio? If you trade 12 times a year, those commissions cost £120. Painful to see, but feasible. You notice it. You might even adjust your behavior to avoid it. The 0.25% platform fee, that's £375 a year. On a growing portfolio, it compounds. Over 20 years, it can quietly take tens of thousands from your pot, and you will never once receive the bill for it. Look, I'm not trying to help you to find the absolute cheapest broker on earth. I'm trying to help you find one that you can stick with for the next 20 or 30 years without worried about it. Here's how the main platforms break down on annual platform fees for a 100,000 portfolio. Vanguard UK, 0.15% per year, capped at 375 above £250,000. Exceptional value for longer portfolios. Investengine, 0% platform fees for DIY investing, nothing. One of the most competitive fee structures available. Trading 212, free. No platform fee, no trading commissions. The Giro, very low commissions, no annual costly fee for most accounts, excellent for active trading. Interactive brokers. Tiered pricing, but the IBKR LEAP model offers free US stock trading. What's the currency conversion costs though? That's where it adds up. A total free stock trading, but accounts are held in dollars. Every deposit and withdrawal incurs an FX conversion. That 0.5% fee applied to regular contributions over years is a meaningful drag. Moneybox, £1 per month plus a 0.45% platform fee. Reasonable on a small portfolio, worth revisiting as your portfolio grows. Saxo Bank, higher costs across the board, but you are paying for a genuinely professional platform. Worth it if you need it, overkill if you don't. Bubbles lesson. Total costs matter more than individual line items. Look at everything together. Platform fees, trading costs, FX fee, fund charges, and calculate the real annual drag. Fees might not be the most exciting part of investing, but they are one of the very few things you can actually control. Right. 4 and 5. Investing choice and passive investing. Buffett has a standing bet, been winning it since 2008, that the simple S&P 500 index fund will outperform the vast majority of actively managed hedge funds over 10 years. He was right consistently, and that tells us something important about investing choice. More is not always better. What you actually need as a long-term investor is access to 1. Broad global index funds, ideally tracking the whole world, not just the US. 2. European domiciled ETFs, critical for UK and EU investors to avoid US tax complications. This point gets underrated. US domiciled ETFs like SEY or QQQ, the ones you will see constantly in YouTube videos from Americans, are not available to UK and EU retail investors. You need the European equivalents like this one and this one. Which brokers give you the best access? The Giro, excellent access to European exchanges and ETFs, one of the best for range. Interactive brokers, the deepest product range of any retail broker. Is its public traded anywhere in the world? IBKR probably offers it. Vanguard UK, curated range of their own funds, limited to their products suite, but those products are generally exceptional. Investengine ETFs only, but the well-chosen selection of ETFs covering the major indices. Perfect if you want a clean, passive portfolio and nothing else. Scalable capital, solid ETF range plus managed portfolios with a risk-weighted approach. Good for German and other European investors. Saxo Bank, over 70,000 instruments, the most comprehensive range available to retail investors in Europe. On passive investing specifically, investengine and Vanguard UK are designed almost exclusively for it. They are not trying to tempt you with options, CFDs, or crypto. That restraint isn't a limitation, it's a feature. Currency automation and fractional. The currency tax nobody talks about. If you live and add in pounds and your broker holds your account in dollars, every deposit costs you a conversion fee. Every withdrawal, another fee. Every dollar dividend, another fee. These are typically between 0.15% and 0.5% per transaction. Sounds small, but if you are making monthly contributions for 20 years, it compounds into something real. eToro is the main offender here for UK users. All accounts are in dollars. For a long-term investor, putting in $500 a month, that's a genuine compounding drag on your wealth. The Giro Trading 212, investengine, Vanguard UK, primarily pounds and euro accounts. Much better for UK and European investors. IBKR handles multiple currencies natively and has competitive FX rates, but you need to be deliberate about managing your base currency. Automation, the boring path to wealth. There's a concept in behavioral psychology called automation bias. We tend to stick with whatever the default is. Smart investors use this against themselves. Set up a monthly automated investment. Make the default investing, not spending. Vanguard UK excellent recurring investment tools. Set it and forget it. Invest Engine, the whole platform is built around auto investing on a schedule. Trading 2 and 2, auto invest feature, set a portfolio, set frequency, done. Moneybox, the roundup feature is genuinely clever. Every card purchase gets rounded up and the spare change invested automatically. For people who struggle to save, it's a powerful on-ramp. The Giro IBKR more manual, not designed for automated passive investing. Fractional shares. Don't let price be a barrier. Berkshire Hathaway Class A shares cost over £600,000 each. Without fractional shares, you either need serious capital or you compromise your diversification by concentrating in cheaper stocks. So fractional shares available on Invest Engine, Trading 2 and 2, eToro, Moneybox, Interactive Brokers, Scalable Capital, XTB. Fractional shares not available. Vanguard, UK, The Giro, Saxo Bank. For most long-term passive investors using ETFs, fractional availability at the ETF level, which most platforms offer, is sufficient. 9. Interest on cash. When you are building a portfolio, there will always be periods where cash sits in your brokerage account uninvested, between contributions, between decisions, or just waiting. That cash either earns interest or it doesn't. In an environment where rates are meaningful, the difference adds up. Lightyear is exceptional here. They pay interest on uninvested pounds and euros cash, which is one of their genuinely differentiators. Interactive Brokers pays competitive interest on cash, one of the best in the industry. Vanguard UK limited interest on cash. eToro Trading 202 limited or no meaningful interest. Idle cash in a zero interest account doesn't just sit still, it quietly loses purchasing power to inflation every year, so make your cash work even while it waits. 10. Broker quality beyond the numbers. This last one is the hardest to quantify, but arguably the most important. What is it actually like to be a customer of this broker for the next 30 years? Ask yourself, can I transfer my portfolio without selling everything? This is an in-specie transfer, moving your actual shares, not cash. Some brokers make it easy and cheap. Others make it deliberately painful to keep you locked in. What's the customer service like when something goes wrong? And something will go wrong at some point. A transaction fails, a dividend gets misposted, an account gets flagged. Who picks up the phone? Is the broker profitable and financially sustainable? Several newer fintech platforms have operated at a loss, subsidized by venture capital. Not necessarily dangerous, but worth noting. How long have they been in business? Interactive Brokers, 46 years. Vanguard, 50 years. The Giro, 17 years. eToro, 18 years. Trading 2 and 2, 21 years. Scalable Capital, 11 years. Moneybox, 10 years. Invest Engine, 6 years. Lightyear, 5 years. Longevity isn't everything, but it correlates with stability, and stability matters when your financial future is on the line. Alright, you've sat through the framework. Let's make it practical. The UK beginner. I want to start simply and do it properly from day one. My recommendation, investengine plus Moneybox. Open an investengine ISA for your core long-term portfolio. Zero platform fees, excellent ETF selection. Automated investing. You can build a world-class passive portfolio on this platform for essentially nothing. Add a Moneybox lifetime ISA if you are under 40. Put in £4,000 a year, collect your £1,000 government bonus. Don't overthink it. For a patient, Moneybox, Seek or Vanguard Seek. Both solid, low-cost options. What you avoid: platform fees, FX costs, and tax you simply don't own. The UK long-term passive invest. I want low cost, simplicity, and tax efficiency as my portfolio grows. My recommendation: Vanguard UK primary, Invest Engine secondary. Vanguard UK for stocks and shares ISA and SIP. Their own funds are among the cheapest, highest quality passive products on the market. The platform is simple by design, no distractions. The 0.15% fee becomes generally exceptional value above £100,000. Investengine alongside it for extra ETF exposure outside Vanguard's fund range. Zero fees make it a clean, easy addiction. What you avoid: the temptation to trade, FX costs, and unnecessary complexity. The intermediate investor. I have an existing portfolio and want more control and more choice. My recommendation: interactive brokers plus ISA at investengine or Trading2. IBKR for your non-ISA, non-patient investing, and match product range. Powerful platform, competitive costs once you understand that. Excellent interest on cash. Keep your ISA at investengine or Trading2 to preserve the tax wrapper. Neither charges platform fees. Both support automated investing. What you avoid: paying for complexity you don't need. What you gain: general flexibility and the deepest product access of any retail broker in Europe. The advanced active investor. I trade frequently and need a professional grade platform. My recommendation: interactive brokers, primary, Saxo Bank, alternative. If you are here, you already know what you need. IBKR for most unrivaled product access, excellent margin rates, professional charting via TWS, and the financial stability for a 46-year-old institution. Saxo Bank if you want a more polished experience and can absorb slightly higher costs. Youthful platform, excellent research. European investor, non-UK. I live in Germany, Netherlands, France. Where do I go? My recommendation: DeGiro plus scalable capital plus interactive brokers. DeGiro for the best combination of low costs and broad European market access, outstanding for ETF investors across Europe. Scalable capital for a more automated passive approach, particularly strong for German investors. Their Prime subscription at €2.99 per month effectively gives you free flat fee trading. Interactive brokers for anyone wanting full multi-currency, multi-asset access. Note: for EU investors without UK ISAs and SIPs, the tax efficiency story is different. Focus even harder on costs and ETF domicile. The should I use eToro? Invest. eToro is fine. Legitimate, regulated, large user base, generally clever copy trading. But for long-term UK investors, the USD only accounts and the associated FX costs, combined with no ISA or SIC, make it a structurally disadvantaged versus the alternatives. If you are using it for the social investing element or alongside another account, absolutely fine. If it's your only investment account and you are building towards retirement, I'd seriously think about whether your primary broker should have either accents. Side questions. Answer them in order and we'll know exactly where to go. Question 1. Am I based in the UK? Yes. Your primary broker must support ISAs, ideally LISAs and SIPs. No. Cost and regulation become your primary filters. Question 2. Am I a passive investor, active, or both? Passive, investengine, Vanguard, scalable capital. Active, IBKR, Saxo, DeGiro. Both IBKR for the active side, zero fee ISA wrapper alongside it. Question 3. What's my portfolio size? Under 50k, zero fee platforms, investengine, trading 2 and 2 are optimal. 50k to 250k, Vanguard's percentage fee is still competitive. IBKR starts to look attractive over 250k. Vanguard's fee cap makes it exceptional value. IBKR for anything outside the wrapper. Question 4. How important is automation? Set and forget, Vanguard, investengine, Moneybox, scalable capital. Active management, IBKR, Saxo, and DeGiro. Question 5. Do I need multi-currency support? Pounds only, Vanguard, investengine, trading 2 and 2 are fine. Pounds and euros, IBKR, best light year for simplicity. No broker is perfect for everyone, but the wrong broker for your situation will cost you far more than any individual investment mistake. Whatever broker you pick, choose one that allows you to transfer your portfolio for free and without hassle. Because if you are on the wrong trade, the fastest you change for the right one, the better. And remember, the broker doesn't make you rich. Your investment behavior does. That's why I still mainly invest with Vanguard. Transparent, predictable, low fees. Long-term principles designed to help investors stay the course and reduce short-term reactions. Simple, diversified products. Index funds and ready-made portfolios, and options for both hands-on and hands-off investors. Personally, I'm not keen on paying professionals to manage my money. A high fee is a hurdle a fund manager has to clear. Just broke even. It's like starting a race behind the start line, not a position I find attractive. Let me leave you with this. Choosing a broker is not the most exciting thing you will do in your financial life. It won't get you likes on Instagram. Nobody's going to ask you about it at dinner. But 30 years from now, the quiet decisions you made at the beginning, the accounts you opened, the fees you avoided, the tax you never paid, those will show up in your final number more than almost anything else. Not because you are clever, not because you found a secret, simply because you understood that in long-term investing, the game is won by not losing, by not paying what you don't have to, by not being taxed on what can be sheltered, by not switching platforms every few years and paying transfer fees and spread costs and losing your ISA history. Jack Bogle built a $1 trillion institution on one idea, that ordinary investors deserve the same returns as the market, minus as little as possible. That idea starts with your broker. Choose carefully, start early, automate everything you can, and then, generally, don't touch it. Investing is like handling a bar soap. The more you use it, the faster you lose it. Don't trade every day. As Buffett said, if you aren't willing to own a stock for 10 years, don't think about owning it for 10 minutes. I don't believe in day traders. I don't believe in get-rich-quick schemes. I believe that in a world obsessed with short-term thinking, being a long-term investor is a genuine competitive advantage. It's about preparation, not prediction. It's called investing, not gambling, for a good reason. If this was useful, subscribe, I do these deep dives regularly, and I'll always tell you what's actually true, not what makes a good deal for me. Links to all the brokers mentioned are in the description. No affiliate links. My opinions are my own and always will be. See you in the next one.